All right. Good morning, everybody. My name is Robert Whitaker with Merkle Science. We are having another Merkle Meet. So, good morning if you're in the U.S., good afternoon if you're in the U.K., or wherever you're in the world. Good day to you. So, this morning it's going to be the year in stablecoin oversight, how compliance teams are preparing for 2026. This year in 2025 has been kind of a whirlwind. Things have been happening very quickly. And stable coins are certainly out front leading kind of this new technological advancement in payment systems, and it's going to be a great panel. We have four very, very experienced persons in compliance, not only that, but stable coins as well. And I'm going to let them introduce themselves because I could do some real damage to their reputations if I try myself. So I'm going to start with Lauren first, and then Laura, and then Justin, and then Carolyn. So Lauren, if you want to start off on the introduction.
Sure. Hi, everybody. My name is Lauren Benjamin. I am the Chief Compliance Officer for Kraken's U.S. operating entity. We are a digital asset service provider or a centralized exchange here in the U.S., one of the largest. And I've been in crypto for 6.5 or so years. And then prior to that, I was a former banker, was what we usually say in the crypto environment. A reformed banker. And I was in the AML world and in the formal finance institutions for about the prior, I don't know, 7, 8 years before that.
Excellent, excellent. Thank you. Laura?
Hi, Laura Dalvidier. I sit at PwC, a London office, but I work globally across our business. I lead our digital assets regulatory side in the UK. I work a lot in risk and compliance and also hold the relationships with especially the UK regulators and authorities.
Nice, very nice. Justin.
Hi, everyone. My name's Justin Levine. I'm a senior associate at Davis Polk. I'm based in New York. I work in the financial regulatory group with a focus on crypto regulatory issues. In particular, I've been very focused on stablecoin regulation for some time, both with the New York's bit license regime and now focusing quite a bit on the Genius Act, advising both crypto natives and a lot of existing stablecoin issuers, as well as various banks and fintechs that are pursuing stablecoin opportunities and various clients that are looking to uh, get licensed under the Genius Act as the act comes into effect. I'm also an advisory board member of Stablecoin Standard, which is a global trade group for stablecoin issuers and other crypto companies advocating for uh, clear and harmonized rules across jurisdictions. So I think this is a great topic and very timely topic, and excited to speak with you all about it.
Excellent, excellent. Thank you. Carolyn, nice to see you again this morning.
Good to see you too. I will keep it short and sweet so we can get to the meat of the discussion. My name is Caroline Hill. I'm at Circle, which I hope you all know, but is the issuer of USDC and EURC, the largest regulated US stablecoins or US dollar stablecoins. I've been at Circle for about 4 years, where I've been focused on all things AML, CFT, and Genius related, way before Genius was even a term. It was called many different things before we had the Genius Act signed into law. Before Circle, I spent the majority of my career at Treasury working on sanctions and AML, CFT work. And that intersected, as you can imagine, when I started at Treasury in 2014, intersected with the advent of digital assets. And in 2014, we thought only people were using digital assets to buy illegal things. And by the time I left Treasury, we had a very different opinion on the utility of digital assets, which led me to Circle. So I'll turn it back to you, Robert, and looking forward to the discussion today.
All right, thank you very much. So as you can see that we have a star-studded panel here this morning. This morning we're going to talk about not only the Genius Act, but we're going to talk about MiCA and the EU, and we're going to talk about the UK. Laura's here from the UK, and I'm sure she has some great insights for us. And we're going to talk about how things are shaping up: the Genius Act, MiCA, EU standards, UK, and global oversight. And the panel before everyone got here this morning, or at least two of them, were talking about reciprocity And I think that's going to be a great addition to the whole thing, is reciprocity on how things are shaping up around the world globally. So I'm going to kick off the first question here, and I'm just going to throw it out. So whoever wants to take it, we can take it. So let's get started. So the first question we have for the panel is, how are the US, EU, UK, and APAC stablecoin regimes converging or diverging? And what early supervisory patterns should issuers treat as signals for 2025 and 2026 licensing? And then we'll get into a follow-up, but that's the question here. So how are these regimes around the world, I guess, converging and diverging? What's the early supervision patterns, and how are we going to see this developing in 25 and 26? Well, why don't we start with Laura then? She's from the UK. She can give us an international perspective.
Yeah, shall I start? Well, the good news is that they're moving along. So all the biggest hubs, the usual ones we often talk about, they are making progress at slightly different speed. Obviously, EU's got the rules already. The likes of Hong Kong, Dubai, and the US close behind, and then you've got the UK, maybe slightly more behind, but we're getting there. But the rules, when you look at them on a high level, they look very similar. You've got your redemption, you've got your prudential, you've got your basic compliance and sort of controls requirements. But then when you dig a bit deeper, there are some differences. Some of the examples, for instance, the UK is proposing, or the Bank of England in the UK is proposing holding limits for systemic stablecoins. And sometimes the redemption rules can be different. Sometimes it might be 24 hours, sometimes it might be 5 days. So those are sort of operational pain points, or things that firms will need to consider at all sides throughout the ecosystem, how to make those work. I think, and to your next question, you talked about the supervisory patterns. What we like to say at PwC, at least within reason, we like to go with the sort of banks level standard of all the requirements, and then make sure that the sort of 10% digital assets is there as well. But that's probably sort of the most sensible in most cases if you're a global firm, the way you want to go, to just make sure that you can manage the different rules in the easiest possible way, because otherwise you might end up with implementing different rules for different jurisdictions, but then actually and keeping track of all those might actually be harder than just having the gold standard across the board in the first place.
Interesting. I'm gonna toss it over to Lauren and then Carolyn, because Lauren and Carolyn both are working, for an exchange and one for a stablecoin issuer, and I think the perspective, along with Laura's perspective, could be very interesting here. So, Lauren, what do you think about that first question?
I think Laura hit it right on the nose. I mean, I think the challenge that as a global exchange, as a centralized global exchange that we face, is that we do operate globally, and that you do have various regulatory regimes and slight differentiations between how those regimes approach it. And so even though we have a global exchange, but we have different operating entities that are registered or licensed in all of the jurisdictions that we serve. And so we do have this sort of piecemeal approach to regulatory alignment. What you do in the UK is slightly different, and the reporting requirements are different than what you do have to do across the EU. And it can even vary, depending upon the EU member states that you're operating in, what those requirements are. And then there's the US, which also obviously has a different sort of approach and a different stage in its adoption of rules. And so I think Laura's comment with regards to having a global standard, or having, one sort of strictest common denominator that you want to adhere to across the board globally for your organization, is the sort of unicorn that you want to reach. Because the challenge is, when you have various sets of data, you have different reporting requirements, you have different mandatory net capital worth requirements, you have different redemption requirements across the board, you not only have to make sure that each of your operating entities are aligning to that, but then you also usually have some sort of global operations force that has to implement those same rules so that you can ensure that your global functionings are adhering to the different jurisdictional rules and requirements that you have on the ground locally. So that's an absolute challenge. I do also tend to agree, and I think in the US, especially, I know this is a follow-up, so I can talk about that later, but I think the sea change that we're seeing in the US is this sort of alignment to bank grade or bank-like standards for across the board. And that's a definite shift for the way that digital assets especially are approached in the US, and from a registration standpoint, from a functional standpoint, the frameworks that you set up, whether it be AML, CFT, and sanctions, or consumer protection requirements, or your bank grade, um, you know, I think you called it prudential. That's a very UK way of approaching it, but like the financial requirements that you have to have in the background on the US side. All of that is definitely a shift as we move more towards having the formal financial institution level approach to how you're adhering to regulatory framework. So I think those are probably the two biggest hits that you'll see in the US.
Very interesting. Very interesting. Carolyn, what's your perspective?
We've been really excited to see over the last 5 years regulation come online. I mean, EU was first with MiCA, and I think, in my opinion, was because they already had an e-money framework, and so they could already apply this payments framework. Well, here in the United States, that doesn't have a payments regulator and a payments framework. Took a little bit more time. Mostly, though, or additionally, what we've also been excited in the rhetoric around these regulations coming online is governments understanding that stablecoins are inherently a global cross-border instrument, and they're very cognizant of the fact that they want to have sound regulatory regimes at home, but also not lose that global fungibility. And that's really challenging. That's very different than traditional finance, where you have assets in a country managed by that supervisor versus a global stable coin that can move atomically and settle instantly. And so I think as we have seen MiCA and now the Genius Act and several APAC countries that Laura mentioned and Dubai coming online, that's kind of the next horizon of how do we make sure there's a lot of overlap between these regimes, more overlap than not overlap, but how do we make sure we protect that global fungibility? And then, of course, as countries are thinking about how to protect their own monetary policy and their own currencies at home. Robert, you raised reciprocity, and that's something that is really important in Genius. Treasury has the ability in Genius to recognize a foreign jurisdiction as having a reciprocal regime, and then allowing a payment stablecoin issuer to be headquartered and regulated and supervised in that country and still have access to US exchanges and consumers and the like. This is important not only because it protects US consumers, it allows access to that, but it also uplevels other countries' regulation around stablecoins. And so there's a clear standard, and I think a lot of countries will be quickly hurrying to meet the Genius level of foreign reciprocity, so that stablecoin issuers can be headquartered there in their own countries and still have access to the US market, which of course issuers want as well.
Yeah, absolutely. Global fungibility. That's an interesting term. I don't think I've ever heard it put just like that. Obviously, we all understand what fungibility around the world means, but global fungibility. That's going to be a new definition somewhere in a book somewhere.
I can't take credit for it, but I will on this call.
Okay, great. Justin, I have the second part of that question, which I really want you to follow up with, because I think from a U.S. federal, state, multi-agency oversight, really the Genius Act, what does it mean, right? What's coming online in the United States? And I think you're probably a great person to handle that call. So the question, quite simply, is how should issuers navigate overlapping U.S., federal, state, and multi-agency oversight as they prepare for Genius and the coming national regime? So that's more of a U.S. centered question. So Justin, I'll leave that one to you.
Sure. So the short answer is that Genius is going to remove a lot of that fragmentation when it becomes effective. So we're in an interesting period right now of Genius Act being enacted, but not yet effective. Um, but I'll start with how it reduces the fragmentation. Um, so first off, it just creates a unified concept of what is a payment stablecoin and who can issue it in the US. And there's three categories: subsidiaries of insured depository institutions, federally regulated institutions that would be regulated by the OCC, and then for issuers that issue under 10 billion in outstanding payment stablecoins, they could be regulated primarily at the state level as a state qualified issuer if that state has a stablecoin regime that's deemed substantially similar to the federal regime under Genius. An important part of Genius is it also preempts state licensing laws, so state money transmitter laws, and also other virtual currency specific laws. Um, so today, stablecoin issuers in the US, like one of the key regulatory licenses that they often obtain is these state by state money transmitter licenses. Um, After Genius is effective, those should be preempted. And I think the preemption is a bit stronger for issuers that choose the federal route over the state route, but there is clear provisions as well for state qualified issuers to get a degree of preemption as well. Um, the other important fragmentation that I think Genius addresses is, as I said, what is a stablecoin? It resolves any lingering debate to the extent that there still is of stablecoins are a payment instrument. They're not securities, they're not commodities. Issuers of a stablecoin are not potentially an investment company. There's a dedicated regime that is, as Lauren said, it's a bank-like framework, but it is specifically tailored for this novel payment instrument. As I said at the very beginning, the reduction of fragmentation is, as the Genius Act comes online, the effective date for the bill is the earlier of 18 months after enactment. So that's January 2027 or 120 days after any final rules are issued. Uh, there are countless. I think there's somewhere around like 20 different rules that will have to be issued under the Genius Act. And that's one major theme I actually have. Sorry to take a quick tangent, but one major theme I have is a lot of the Genius Act in the US and I think across the world, a lot of the details still have to be written. So on your earlier question of convergence, I think like the core framework of what is like a fiat-backed stablecoin and what should the reserves be, what should redemption rights and reporting and attestations, all that is like converging at the highest level at least. The details, I think it's a bit too soon to fully say where things might diverge because a lot of it is going to be drilled down in the implementing rules. So I think anyone in this space should really be closely following those comment processes and seeing how those rules shape out. But as I said, the rules is one tied to the effective date. So what I'm seeing right now with a lot of clients, if they are not already a stablecoin issuer, is how do they deal with this interim period? If you issue a stablecoin today, before the Genius Act comes online, like would you have to go about and get close to 50 different money transmitter licenses just for it all to be preempted in potentially under a year? There's other forms of preemption for national banks under the National Bank Act, and there's various considerations in play there. But I think that timing gap is something people are thinking about, and a broad recognition that a lot of this fragmentation is going to be removed by the Genius Act.
Yeah, thank you very much for that, Justin. There's going to be some challenging times with the rules coming up and how those play out. I think the first things that came to mind, well, I had two thoughts while you were talking. One was deference and how deference is going to apply to all these rules when they come into place, because we just had that Supreme Court ruling on the Chevron deference not too long ago. And then I wonder how the U.S. 1860 law is going to impact Genius or the vice versa, how Genius is going to impact 1860 and how companies or just in general, people in general are going to deal with that. So just my thoughts around that. Not worth much, but made me think a little bit.
Those are good
So
points. And if sorry to interrupt, if I could just add one thing based on what you said of the rules and potential divergences. One thing that's important under Genius is there are various uh, federal payment regulators, payment stablecoin regulators, which are basically the existing banking agencies. They're required to issue rules in coordination, but not jointly, uh, which is potentially relevant. So the hope is that each of the different agencies, the Fed, the OCC, the FDIC, the NCUA, are going to issue, fairly standard rules together jointly, but they don't actually have to. They just have to be in coordination. So that's actually one area where there's a risk of potential fragmentation based on the different regulated entity types.
yeah, very interesting. It'd be great if they all got together and made, and actually coordinated on a rule instead of each having a rule or something like that. So I think I'm gonna not send this next question over to Lauren, and then we'll go around the wheel again. So how are firms adapting their risk and reporting frameworks, and what tools or workflows are providing most effective in meeting new supervisory expectations across the multiple jurisdictions? Now, we just covered, I think, a lot of those points, but if we could go just a little bit deeper on, what are the new supervisory expectations across the jurisdictions as they're unfolding, and how are people or companies like Kraken and Circle and legal firms and PwC all considering the new supervisory oversight?
I'm gonna kind of harken back to something that Caroline said when she first got on, because it hit
Excellent.
me as something that I had a very similar reaction. So my first introduction to crypto was back in, I want to say, like 2015 or 2016 as well. And I was working with banks, and it was FBI agents or DHS agents coming into the bank to inform the FIUs of how crypto is essentially utilized by criminal organizations for the purchasing and selling of illicit activity, drugs, human trafficking, smuggling, terrorism financing. That's all we ever knew about crypto. And so it wasn't until I got into crypto that you start to see these practical applications, this concept of financial freedom, global adoption, et cetera, that sort of drive the ethos of the community. And I think with the coming of Genius and then hopefully Clarity Act, it's still the conversation on the Hill and then throughout the sort of public perspective, especially from the banking side and those that are much more familiar with the formal financial world, is that it's still very much the Wild West in many ways with how they perceive crypto to be. And so I think the risk frameworks that we are implementing are, and the supervisory requirements that are embedded in these laws are still very much around consumer protection, ensuring the safety and of custodial assets and the responsible actions carried out by issuers and centralized exchanges. And so, I think the approach that we should have is not just educational, but how to adopt a risk framework to ensure that we are appropriately meeting those consumer protection requirements, that we're appropriately meeting the AML CFT requirements. And so I think, like with anything, the approach to a risk framework is the adoption of appropriate policies and procedures, controls putting in place, data mapping and acquisition and structuring internally to be able to build sound segregation processes, sound reconciliation, sound rebalancing processes, being able to meet your liquidation and your reserve requirements. I think that the focus of the regulators and the supervisory structures are going to be very closely inspecting how we approach that aspect of stablecoin issuing, and then being able to be the dispersing agent, so to speak, as a centralized exchange. So I think what they're looking for is for us to prove that FTXs don't exist, that don't exist, but like that we are not those types of actors, that we are responsible actors in the playing field. And I think the other comment that Caroline had was that having this global reciprocity or a global adoption of this global framework or global payment system will bring up those exchanges that exist outside of those regulatory supervisory regimes to a higher level so that we don't have to worry so much about competing with those extra, not extraterritorial, but like those extra regimes that don't exist within supervisory framework regimes and environments. So, I think with regards to how we're approaching the Rich framework, it's very largely about ensuring that you have the appropriate policies and procedures put in place, that you have testing and control mechanisms to accurately check and review on a very regular cadence, that you're meeting your regulatory requirements, that your reporting capabilities and your transparency are active and open and consistent, that you have sound governance from a leadership perspective, that your leaders are appropriately aware of the processes that you're putting in place, that they're reporting up to the board, that they're responsible actors, and they are the responsible liable parties from a supervisory standpoint in order to ensure that your agency or your organization is meeting your supervisory requirements. I think that is really going to be the key to things like Genius Act and the other environments in which these laws are being enacted.
Yeah, thank you, Lauren. That's a good perspective, and I think what I heard a lot there was, the supervisory requirements are kind of the same as you would see around a bank already. It's just raising your company's level up to the bank standard. I think you're probably already there. I mean, I don't know. I don't work for Kraken or anything, but I think you're probably already there. It's just a matter of applying a different risk approach to it in some ways. I think I want Carolyn to jump in next, and that's because I want to get the international perspective and UK's perspective from Laura last. So, Carolyn, you want to take a shot at it, and then we'll go to Laura, and we'll come back to Justin after that.
Yeah, absolutely. I'm going to focus on the AML CFT question specifically because we also got a question in the chat about how AML CFT requirements are converging and diverging. So I'll actually go a little bit in that direction, if that's okay, Robert. But I think that has been AML CFT continues to be an area of focus, all the way up to the FATF on a international supra government level, certainly a focus on Genius. I think luckily the AML CFT conversation around digital assets has been a focus for 10 plus years. The FATF having early standards on this, FinCEN giving very early guidance on how that VASP CAS, but here in the United States, MSBs, exchanges should be regulated as MSBs as well as issuers. I think there are questions around the margins of this, but the core requirements remain the same. KYC programs, transaction monitoring programs, CDD, et cetera, et cetera, et cetera. The challenges around the margins, I think, involve things like the issuer's ability to freeze and seize assets, some of the questions around that cooperation with law enforcement, particularly in the secondary market. And then there are, of course, the traditional aspects that continue to differ, right? Travel rule thresholds, but that's been a challenge for many years. I think, to put simply, there's a lot of focus and industry cooperation on how to mitigate some of the North Korea threats in AMLs in digital assets vis-a-vis AML CFT tools, but the core requirements to me aren't changing drastically.
Interesting. So the core requirements are really just kind of staying the same. You're just changing a little bit of policy, and it's a lot more complicated than that, I suppose. But I mean, at the end of the day, that's kind of what it comes down to. Laura, it's the same question, except from a more global perspective. What the supervisor expectations are now, and what's most effective?
Well, I think we're going to see sort of more scrutiny for crypto natives as we have previously, but as the frameworks develop. And that's rightly or wrongly. And part of the reason is that, quite honestly, many of the regulators are lacking the skill set and expertise and knowledge in this field. So what is the best way to learn is to stay close to the firms. So it is for that reason as well, rather than being suspicious. But for instance, in the UK, if you are crypto native, you have to register under the FCA, or with the FCA under the AML KYC rules. And from next year onwards, the new framework is expected to come in that will then raise the bar towards the banking level of authorization. And we've got about 53 firms, I think, currently registered under the FCA, and they believe that it's going to go down quite a bit with the new FESMA-based rules because firms just are not there, basically. There might be several reasons, but one of them is that the expectations will be quite a bit higher. And yeah, some firms just, for whatever reason, don't think that they can meet those or don't want to meet those, focus on other jurisdictions instead perhaps. But so yeah, there's a lot of work that firms need to do globally. But one of the great things I think is I in my previous life I worked with TradFi, especially banks, and building operating models. And what I think crypto natives have in their advantage is that they don't have the decades-old IT systems that they now have to adapt for these new rules. But they're a lot more agile to build something new, real time, automated, AI'd, all these screening tools and scenario playbooks and event reporting and various bits and pieces that you need for rec and controls perspective and operationally. So that's a good thing, at least, that you've got more of a blank sheet to play with and then build that best practice.
That's a very interesting point. Years ago, 18, 19, I would often get questions about how good can compliance actually be in the crypto space. And my explanation was the crypto space is building compliance tools from the ground up with the latest technology incorporated. And now with AI, it's even better, I think. At least making links is much better. Whereas the banks out there are working with 40-year-old technology, and they're trying to put these nice, pretty layers over top so it looks nice, but it's still the same technology on the back end. Because how are you going to replace someone like Bank of America with all their data? How are you going to take that offline and replace a system? I can only imagine the IT people going over there going, we're going to roll out an update tonight, guys. You can just about hear the panic going on when they say things like that because of all the data and the massive infrastructure they built on their IT stack. So great point. And I think compliance in the crypto space is far better than the banks have, and I think it's going to continue like that. But we'll see, right? It's a wait and see thing. Justin, I saved this question for you just so you can go last because I think this is right down your expertise alley. So it's in the same risk framework question. It's just part two. Where should issuer responsibility end? So where should I, as an exchange or somebody, end? Where's my responsibility in? And where does the ecosystem responsibility begin? So, that's almost like an innovation sandbox question. Where am I, responsible, and where does just, we can't control these risks over here because, it's part of the ecosystem. It's what it is.
Yeah, so I would say issuers are expected to control the risks that they create or, they are in the power of addressing. So in terms of issuing a stable coin, it's the obvious things like the reserves, the redemption practices, the governance, the AML practices for who you're issuing your coins to. In terms of the broader ecosystem, I think a main category to think about is the custodians and the wallet providers that are holding, that could be holding stable coins on behalf of customers. So from a US perspective, and I think other jurisdictions are taking a similar approach of imposing customer protection requirements, particularly around asset segregation and a prohibition on commingling customer property with the custodian's property. The Genius Act has strong protections there. There are limited exceptions that I think are really smart and make sense. So generally, a custodian cannot commingle customer stablecoins with their own proprietary assets, but the custodian could hold a small amount of their proprietary assets to pay gas fees on behalf of customers. So things like that. Otherwise, though, clear segregation and anti-commingling restrictions. Um, and then also in Genius Act is a directive for custodians to take appropriate steps to protect customer property from creditor claims in the event that a custodian went bankrupt. Genius Act also has, detailed provisions for a potential issuer insolvency, but at the end of the day, most people are holding their stablecoins either in their own self-custodial wallets or through third-party custodians. So it's important to address those things as well. So in terms of the ecosystem, that's the first thing that comes to mind, like the custodians. Broader ecosystem, another kind of thing that comes to mind is just the third party risk analytics and compliance firms. I think that's going to be a really important area. In terms of the AML expectations, I think Genius Act and other laws in other jurisdictions are really clear. These laws apply to you. You have to have these policies and procedures. But I think the actual details, at least in the US, of like what exactly you have to do to police, or not necessarily police, but monitor secondary market transactions. So, when the stablecoin is just out in the wild being transacted, potentially, among anonymous actors, like how can you do that risk analytics? And I think there's a lot of blockchain analytics companies that are out there that do these things. And I think that's going to be one key area, like to see what Treasury and the other regulators say in their rulemaking, like what the expectations are in the secondary market there.
So they say every rule has a name associated with it, and I think in this case, Genius probably has a couple of the recent examples of FTX, Celsius, and a few others that kind of brought all that about, which I guess is the U.S. taking a lesson out of some of the recent failures, certainly with commingling customer funds and custodial issues. So, yeah, thank you very much for that. So we're going to move on to the next question. Lauren, I'm going to start with you, and we'll go with Carolyn again, then we'll do Laura, and we'll get down to Justin in the end. So, and I think this is probably one of the biggest questions for the very early adoption of Genius, and then how we move down the line. And it's what are regulators today most focused on in early applications? So, we got the Genius Act, it's signing into law. We're still waiting for the Clarity Act, but regulators are right out of the chute. They're just looking at this. What are the regulators most focused on in these early applications and early stablecoin adoption?
I think it's, the things we've already really sort of touched on already. It is the policies and procedures around segregation of assets, of custodial holdings, of the ability to maintain your reserve requirements and be able to permit, active and instant redemption when and where possible, responsible acting on the financial side. On the AML CFT side, I think you guys are all spot on, as a global exchange, as a US-based exchange, we are money transmitter licensed. We have to now register on the federal level, irrespective of preemption and reciprocity and all that. The expectation is that you will have a sound AML, CFT, and sanctions program in place and meet those sort of global best practices with regards to your KYC, your CIP, your transaction monitoring, your appropriate suspicious activity or suspicious transaction reporting, depending upon the jurisdictions you're located in. So I think the expectation should be that as you apply for registration in these various areas, that you have sound mechanisms, governments, policies, procedures, and controls in place to meet your fiduciary requirements of reserve holding, of reciprocity, or not reciprocity, of redemption, and of appropriate segregation of not just customer and operational funds, but also operational and customer funds between operating entities. They want to see what your intercompany receivables look like. They want to see what your permissible investment report look like. All of the sorts of like requirements and reporting are going to be keyed in by the regulators, I think, immediately. And I think, and this is something that I sort of hark on anytime this sort of question comes up, but for new applicants or newer fintechs, or even those of us that have been around for multiple years, the key to developing any framework and the anticipation of an application process should be forethinking. You want to build your structure, your policies, your procedures, your program with the thought of, okay, what am I going to need once I have an examination? How am I going to pass that examination so I don't get findings, so I don't get recommendations that will then cost me more money to have to remediate and implement new processes and procedures? And I think, Robert, you touched on this earlier with regards to crypto compliance versus TradFi compliance. I totally agree. I think in many ways, crypto AML, or like the AML and compliance world on the crypto side of things, is stronger than you would find in traditional finance. And it's not just because of the fact that we all come from fintech, and so we have this newer technology, but the blockchain itself enables for a stronger monitoring process for an asset across multiple jurisdictions, multiple wallets. You can trace the path a lot better because of the ledger and the way that the technology is built. So I think with all of that in mind, if you build the system thinking, okay, what is my gold standard? What do I want my system and my program to look like at the end? You save yourself a whole lot of trouble later on, and money, if you just do it right from the outset. So I think that is how you should be approaching the application process, is like approach it like an examination. How do you prepare for examination so that you're ready at the outset?
Yeah, very, very good. That makes me think, and which I'm gonna give this. I'm gonna kind of change it up just a little bit for Carolyn, but I'm listening to Lauren. I'm thinking to myself, are regulators coming in the door to crypto places now, and certainly with stablecoin issuers, and saying, I know technology is much better here. Show me something that I wouldn't normally ask from TradeFi. Is that an issue, Carolyn? Is that something you see going on?
Yeah, absolutely. I think the digital assets industry has done an incredible job, and I don't want to be patting myself on the back, but the industry writ large, about educating on the benefits of blockchain transparency, and frankly, the blockchain analytics companies have been at the forefront of this. And I think regulators are pretty familiar with the similarities and differences in TradFi, right? We have very similar KYC programs, we have similar CIP, CDD programs, and yet transaction monitoring, sure, looks similar when you look at your customer and one hop away, but it looks very dissimilar when you think about blockchain transparency. And so I think that we've been talking about best practices for years, and now the question to Treasury, to FinCEN, and the broader office of TFI is, what should be the obligations, and how do you memorialize, right? Blockchain transparency and tracing is a best practice, and any regulated entity in the United States worth their salt is doing that. But how do you translate that into regulation? You'll never get a regulator to say, okay, you have to trace 5 hops past your exchange, or past your VASP, or past your CASP, because then what do the criminals do? They go 6 hops, right? So, but yet they want you to take a risk-based approach, and they want you to adopt these best practices. I think what Genius did really well is provide a 30,000-foot framework. Congress did not prescribe every regulation down to the detail, and nor should they, right? It's really hard to change laws. Congress doesn't pass many of them. And so they provided this framework, but and a really aggressive framework, really aggressive timeline for regulators to adopt and make rules around this framework, which is now what regulators are doing. But they have a lot of questions, and they have a lot of details to work through. Treasury, for instance, asked 56, 58, 56 questions earlier this year, going through basically every line of Genius and saying, what does industry think about this? What does industry think about this? The benefit, the good thing is that they're asking industry, not just issuers, but digital assets industry, blockchain analytics, TradFi, anyone who has a role or wants to have a role in this is responding to these questions. So there's a lot of work to be done. We even had Representative Style today, yesterday, who's the subcommittee chairman of the House Financial Services Committee on Digital Assets, encourage regulators to meet the timelines that they've been given to implement rulemaking, because it's a really tough timeline. So we'll see how 2026 shapes up, but there's an incredible amount of work going on right now.
Thank you for the perspective. And I knew there was a question and answer session for the rulemaking, but I didn't realize there was 56 questions that were posed. Maybe I should look into that, right?
Yeah, and that's just from Treasury, right? So you have the Fed writing rules, the OCC, Justin said, right? You have the banking regulators writing rules as well. And they're also, there'll be notice and comment for their proposed rules. But I think something like 370, 380 people responded to Treasury's 56 questions. So they have to go through all that feedback and then draft their positions. Oh, and by the way, we just had the longest government shutdown ever, right? So there's a lot going into this, but I'm really happy and not surprised to see the amount of questions and collaboration that the government's giving to the industry right now.
Yeah, and I think that comes down to the crypto space is kind of it's not so much small as it is communicative. It talks back and forth, and I think a lot of stuff gets shared in the crypto space where you don't necessarily see that to some extent in the TradFi world. Laura, I changed the question up just a little bit for Carolyn, but I'm going to pose the same question to you from more of an international perspective. When it comes to technology in the crypto space and the compliance, what are you seeing from a more global perspective on what regulators want, technology, and how they're framing early adoption and what's going on out there?
Yeah, thank you. I agree with everything that has been said so far, but actually, to a point about technology, it's not only about that. So what I spend a lot of time talking about with crypto firms, not just stablecoin, but crypto natives overall, is actually about governance structures. So at some point, firms need to grow up a bit on that. Everybody wants to be nimble and agile and move fast and break things. But the reality is that in financial services, you need to have certain committees, you need to have certain oversight, you need to make sure that you have the right people with the right experience and skill set in the right roles. And that is not just a couple of people making decisions behind the closed doors. So this is what the regulators will want to see more and more. And the second one that would incorporate technology is stress testing and crisis scenario testing. So it's one thing of having all these policies written down, but the regular testing is required, and that's what regulators everywhere will want to see.
Interesting perspective on let's move fast, be nimble, and break things. In the startup world, that's kind of what you get when you first meet with the CEO in a startup is, hey, we're going to go really fast, we're going to break some stuff, and we'll ask for forgiveness later, basically. But I agree with you. This is not that world anymore. This world has changed. And I think, and no disrespect to a lot of friends of mine who like to wear their Chuckies and a pair of jeans and a shirt says Bitcoin on it. I appreciate that. We can't judge books by their cover, but people want to see more of the professional C-suite these days, doing more regulatory financial compliance in the crypto space. I think it builds a lot of comfort around what you're doing. So thank you for your perspective, Laura. That's very interesting. Justin, we have just about 3 or 4 minutes left before we need to get some questions. And I thought this last question would be perfect for you. From your perspective, what will define a credible, globally trusted stablecoin ecosystem by 2026? That is a huge question to unpack, but if you could do it in a couple of minutes, that'd be great.
Yeah, what a question to answer and sum it up in a minute. I think, one way to tackle that is, I think, integration of stablecoins into financial infrastructure, like the traditional financial infrastructure, and increased usage for real economy use cases for stablecoins. I think having clear rules of the road was just critical for that to happen. And now we are entering the stage for, I think, all sorts of companies to start using stablecoins at scale for new use cases and taking advantage of what, real-time settlement on a public blockchain can provide. I'm seeing all sorts of companies beyond just looking to be a stablecoin issuer, but integrate stablecoins into existing flows or using it, say, as collateral for existing, say for derivatives transactions. The CFTC is doing a lot of work on that. But I think that is kind of the key thing I'm looking forward to seeing is integration of stablecoins, not just by, the issuers, but throughout all sorts of financial infrastructure going forward.
Hmm. Okay, great. Interesting perspective. Appreciate it. Um, I have a couple questions here from the audience, and I think this one right here is one that I'd like to get to. And if I could just take maybe 30 seconds from each person to answer this. What measures in the Genius Act and MiCA do you consider most likely to change in the future? And the example they gave here was prohibition to pay interest yield. So between the two, MiCA and Genius, what do you think is most likely to change and maybe even come into alignment with each other? Lauren, 30 seconds.
Um, I think the question about reciprocity is important, trying to figure out exactly where different regimes are going to need to be registered across the globe. I'm not sure that that's a change so much as a decision that needs to be formalized and finalized. I do think the yield question is a really interesting one. It's one that you definitely find within the crypto community as being pushed for, how do we implement yield on stable coins effectively and keep it out of, securities level understanding, but also be able to permit it and regulate it and appropriately store it. So I think that that's definitely one that's going to be in the world of a question that we're going to have to figure out within the next number of years, and we'll be for.
Yeah, the yield products, the earned products, along with the loans, I think in stable coins is a major draw for the customer base. So, if we ever found our situation where we were making that much more complicated or changed the rules or framework around it, I think it would really take a lot from stable coins.
Yeah,
My
centralized
opinion.
lending will be an interesting part. I mean, decentralized lending you see a lot in the crypto space. So I think moving that on to the more regulated side is going to be an interesting question as well.
Yes, I agree. Laura, you want to take a shot at that?
Sorry, I there was a break in the line.
Okay, sorry. So I'll pose the question again.
Yeah.
What measures in the Genius Act and MiCA do you consider most likely to change in the future? Maybe coming into alignment, and the example was the prohibition to pay interest yields.
Oh, I would like to just see and hope to see more passporting, more legal regulatory equivalence between these and other reputable jurisdictions. So that's, I suppose, my sort of catch-all high-level answer.
Okay, all right, perfect. Carolyn, I know you got some thoughts around this.
On the yield issue, I mean, I think Congress has intimated, or more than intimated, that they're not going to revisit Genius at this time. But devil is always in the rulemaking details. However, I think the federal banking regulators that are writing these rules have closely worked with Congress when they were drafting Genius, and I don't think you're going to find a major right turn in the rulemaking. I think paying exchanges paying rewards is not a stablecoin issuer paying yield. It's two very different things. So I don't think you're going to see major changes there. We've kind of for years talked about MiCA 2.0, which is looking at DeFi. I think The United States is very far from looking at DeFi. We're still looking at market structure, but that still remains a regulatory question mark. Is what are the standards and possible regulatory framework over DeFi?
Yeah, so DeFi is going to be there's a lot of things going on in DeFi. It's not a simple question at all. It's a tough one to unpack. So I'd love to see the U.S. come around to doing that in a responsible way, getting some regulation out with it. Justin, the question here, the last part, what do you see going on with the regulation that's coming out with Genius and the rulemaking? What would be kind of the worst case scenario for the rulemaking versus the best case scenario? I know it's a lot for a few minute answer, but there's a lot of rules that are being written right now. A lot of agencies are looking at the Genius Act, and really make it work. You're going to have the rules. So what would be the worst case versus the best case scenario?
I think the worst case is some combination of uncertainty and divergences of rules across the different regulators. I think what's key is clarity, clear rules of the road. More so, obviously what the rules actually say is critically important, but I think like one of the first thing is just having clear standards. And then, as I said earlier, the rules, the various regulators implementing this have to coordinate, but they don't actually issue the rules jointly. So I hope the coordination leads to actually, still doing it jointly, even if it's not strictly required. But worst case would be unclear rules and different standards for, you know, stablecoin issuers that are regulated at the federal level versus as non-banks, stablecoin issuers that are subsidiaries of banks versus versus stablecoin issuers regulated at the state level. I think we want to see harmonization and clear rules.
Very good. Very good. I think that's what we're all hoping for, some overarching regulation that clears up a lot of the lesser jurisdictions, and all the registration that has to go through, MSB and then MTL and then, all these different, and then each 50 state having their own different regulation on top of that. It can be quite the nightmare. I've had to deal with that. So, yeah, thank you very much. I hope the best case scenario is what we see. Ladies and gentlemen, we are out of time. We are right up against our limit now. So I want to thank Lauren, Laura, Justin, and Carolyn for joining me today. Super panel. Some tough questions. I agree. Some of those questions were tough, but you guys, as usual, knock it out of the park. I appreciate everything you've done for us this morning, and thank you for joining us on Merkle Meets. And have a wonderful day, a wonderful evening, depending on where you are. And let's do it again sometime.
Thanks, Robert.
Thank you, everybody. Have a great day. Bye-bye.